All right, well, welcome everyone. Today we have the pleasure of having Mr. Refractor from the Pryzm team joining us. For those that are not familiar, Pryzm is a new option out there for yield trading. I know there's a lot of folks here in the dojo who are pretty active on Pendle, and so this is a similar yet different product. And so just really excited to learn about that. So welcome, Mr. Refractor. Maybe we can just start off with a little, introduction, if you don't mind, just like telling us a little bit about, your who you are and a little background on what Pryzm is, and then we can kind of dive in.
My background is I used to work in high yield and distressed debt and derivatives at a couple of different investment banks. So JP Morgan and then Goldman Sachs in the last bit of my career. So I came at DeFi through a more, I feel like fixed income cash flows type of perspective rather than the proof of work, no cash flows kind of perspective. And so in like 2020, 2021, I started following it a lot more actively when I saw that there was kind of like, real yield and dividends getting paid out block by block and that kind of stuff, and got a lot more interested in it. I kind of had an idea for interest rate derivatives and yield derivatives on just the stuff that I'd known from TradFi on the blockchain in 2021, and so for better or worse, ended up writing off to Do Kwon and a couple of other people, and Do was the one that ended up picking up my message, and so he agreed alongside Jump Crypto to kind of help me build the first version of like yield tokenization and yield trading on the Terra blockchain. And so we kind of launched a project that did that in 2022, and then obviously the 2022 crash happened and Terra imploded, and so we were left thinking, what do we do now? There were quite a lot of issues we've run across trying to build something with smart contracts that really limited the functionality that we needed to have if we wanted to build, I guess, yield tokenization and interest rate swaps as like something more scalable. And so we went back to the drawing board and I guess kind of looked at our different options of, do we want to build a subnet? Do we want to build on ETH L1? Do we want to start looking at some of these L2s? Do we want to build on top of another Cosmos chain and just kind of like lift our contracts that we built before? And we kind of like in the end settled on building our own custom blockchain using the Cosmos SDK, and that kind of that was June 2022. We decided to kind of do that, and then we've been building it ever since, and trying to think of problems from first solutions and try and emulate a lot of I guess the experience I had in TradFi of how these things trade, rather than necessarily like leveraging too much off how things work in DeFi. And so
I do think there's something kind of interesting there, which is, I think it's a pretty DeFi native, group we have here in the DeFi dojo. People have been, in crypto for a long time, using DeFi probably, since its first iterations, and maybe have a little bit less experience on the TradFi side of things, and don't maybe appreciate the scale of this, right? Like yield trading, fixed rate stuff in TradFi is kind of like the bread and butter of the system. Would you mind just like giving folks a little bit perspective of like, how big the market really is in TradFi, and why there's so many people that are kind of trying to crack this in DeFi, and like what it potentially could unlock?
The interest rate swap and interest rate derivative market is $700 trillion, I think, in TradFi, and it's, I think, by far the biggest market. Like dwarfs equities, dwarfs FX, dwarfs normal fixed income. I think the reason, there's obviously a lot of underlying things in TradFi that make it such an interesting market. Like, people need to hedge out mortgages, credit cards, auto loans, all of these all of these kind of bits and pieces, and banks are hedging off the risk of lending to people. And so you have this huge, basically, fixed to floating swap market, which is kind of, for people that are familiar with Pendle and Pryzm, that's sort of, a part of what you end up doing. And then, like, my view was, when we started building it, the yield derivative market in crypto was $0. And I think as the market matures, the composition of the DeFi market is going to emulate, or definitely have a much higher correlation to, the market composition of TradFi. And so I think yield and yield derivatives and tokenizing and trading of that is going to be a massive part of DeFi going forward, particularly as more and more of this stuff starts moving on chain, and more interesting yield sources that aren't just kind of like, points farms and stuff like that start coming, and people are looking for a way to sell their future yield or hedge out yield risk, or that kind of thing. And I think structurally, yield will come down, yield volatility will come down, and people will be a lot more focused about, that marginal couple of percent they can make doing one trade versus another trade, because of the compounding effect of doing that, rather than, moving from X farm at 200% to another farm at 300%, and you sort of don't care about getting absolutely destroyed on bid offer costs, because you're moving between such kind of high yielding things. And I mean, in TradFi, the way you end up trading these markets is you'll end up trading everything basically through an investment bank. Most of the largest market participants are, in terms of volume, are hedge funds, and you obviously get, you get governments using this market, you get huge corporates using this market. Apple will issue a floating rate note, or borrow debt with a floating rate, and then they'll instantly go to, Goldman Sachs, JP Morgan, Bank of America, whoever, and say, okay, well, like, give me an interest rate swap now, so that I can hedge out my risk on the floating rate debt that I've just issued. And so you get all that kind of stuff, and like, a lot of it doesn't trade. A lot of this debt is like, particularly as you go down the spectrum on, sovereign, like more emerging market sovereigns, or less kind of liquid things that aren't necessarily just the German sovereign, the Bund, or treasuries in the US, for example, or gilts in the UK, or these most liquid markets. A lot of these things will trade a bit to trade a bit more. Whereas I think in DeFi, one of the big things that everyone kind of expects is atomic liquidity in exactly the size you want to do right now for most people. Whereas, like, the reality is, particularly in some of the stuff that I was trading it, on the more distressed side at Goldman Sachs and JP Morgan, was, you would pay a percent bid offer to do $1 million's worth of dollars in a trade. These are this hedge funds that were doing this, and they'd want to, their total position size they'd want to buy would be like 30, 40, $50 million, and they're only able to trade $1 million in one trade, and then kind of, leave an order to work some more, or that kind of stuff. And I think DeFi will end up moving more that way, when people realize that you can't just incentivize everything with huge liquidity incentives into perpetuity. Like, people are going to start trading stuff by appointment more, or using indications of interest, or RFQs, request for quotes, will become more prominent, I think in DeFi. But yeah, like, it's a absolutely enormous market in TradFi, and I think some of the use case, Pendle's done an amazing job of getting kind of eyes focused on this market. But I think yeah, as the market starts maturing and it moves away from kind of points and launching, there's going to be lots more kind of interesting opportunities.
Awesome. Well, I appreciate you breaking that down for us. And you started talking a little bit about the design decision of like where you guys were building, and I think it's an interesting maybe introduction into like kind of getting more specific into what Pryzm is in itself. But would you mind just like walking us through? We've had a a lot of discussions in here. Like I think people in the dojo tend to be, pretty ETH focused, just, as a general, like on mainnet, on the L2s. You can probably also, if you've been around the chat a little bit, see there's also folks that are quite interested in Cosmos, that are quite interested in the modular ecosystem. I think it would be an interesting perspective as we kind of start breaking down what Pryzm is, why you guys decided, to build the way you did rather than being, a DApp on EVM, or being on the Cosmos Hub, or on Osmosis, or being a roll app, or whatever the options were. It is kind of, I think, maybe an interesting introduction into, how thoughtful you guys have been in creating this, and why you decided to build what you guys have ended up building.
Yeah, I think there's two like main overarching themes. I think that that were the reason we took the design decision that we did to build our own blockchain. The first is purely just like vertical integration. Like me and my co-founder sort of, I think, strongly believe that, and the reason you see so many crypto startups and that kind of stuff is because startup costs relatively are pretty low, and the barrier to entry is extremely low on this stuff. And so, if you in a world like that, if you're not vertically integrated and you don't control your whole kind of stack, and you start building on top of other people, or so using other state machines on other L1s, or whether you start using other people's LSDs, for example, and you're beholden to kind of like their fees or their smart contract risk, you're sort of layering risks upon risks upon risks and being beholden to more effectively suppliers. If you do that, so like one of the sort of fundamental decisions that we made was, if we're our own blockchain, then we completely control the software stack, but then we also control the revenue capture of the protocol. So, rather than just building on top of, say, for people that know, like Stride's LSDs, for example, in the Cosmos or something like that, like what we've done is we have our own blockchain. So we generate the revenue from gas fees, we generate revenue from all the MEV and arbitrage flow that happens as a result of these derivatives. We generate revenue from the AMM that we've built that we can talk about this, very different to Pendle's AMM. We generate fees from, we create our own liquid staking derivative. So whilst we accept external liquid staking tokens, we create our own liquid staking derivatives as well. We take fees from the yield tokens, similarly to Pendle, and kind of like other sort of bits and pieces. And it means that you're much more in control of your stack. Like we have a Oracle module we've built into our blockchain, so we're not dependent on like third-party oracles. So, and that's kind of something you can only do when you build your own blockchain. Like our validators every block report in important Oracle information, like the exchange rates on LSDs, so we know when yield's being paid out, and yield needs to be harvested and collected. So it's all kind of like that sort of thing. It's like the bit from like the revenue capture side. And I think like I'm probably maybe not a modular maxi at all. So like I sort of feel like you're just adding in suppliers into your supply chain that control your kind of fees, and can you can at some point in the become hostage to governance decisions on some of your suppliers, blockchains or protocols or whatever it ends up being. And then I think the other part of it is, when you build on another layer one, your option is to build with smart contracts. Whereas when you're building on your own blockchain, your option is to build with either smart contracts or your own bespoke modules that are built into the blockchain, that are like their own individual kind of state machines on the blockchain. And so you're basically giving yourself another tool to build with in your arsenal. And so like an example of that is like every time someone wants to interact with a smart contract, they need to send a message that obviously goes to the mempool validator to decide whether to include it or not. So like everything gets upgraded, like gets committed to blocks like that. Like with a when you've built core modules, you're effectively no one is required to send a message. Your state machine gets updated, you're validated. You can have like begin block or end block logic in Cosmos, which will operate functions automatically without users or third parties needing to send messages. And so we had the option of building with modules or smart contracts, and every single thing we've built on Pryzm is with modules. So I think that kind of like shows the sort of power of building with modules rather than smart contracts when you're given the choice of doing both, and you end up building with modules. So that's kind of like the main two decisions: vertical integration and just the power of building with modules compared to building with smart contracts.
It's something, because there is so many options these days and so many different blockchains building in different directions. It really is valuable to kind of like hear your guys' thought process and why you decided to go one route or the other. But let's jump into the protocol. As I said, we have a very active community of yield traders. I know folks in here have been trading everything from LSTs to LRTs to different stable coins. I think a lot of it has kind of really popped off recently with like the points mania of the last, I don't know, 6-8 months or whatever it's been. But let's get into like actually understanding Pryzm and how it works, and the different pieces of it. I can see just kind of like going on to your guys' DApp, some very kind of familiar actions here. But maybe you can just like break it down for us, right? Like I'm seeing providing liquidity, I'm seeing principal and yield tokens. There is this like native minting of you guys are calling them LSDs, which I assume are very similar to just liquid staking derivative. Is that right? The term you guys are using rather than LST.
Exactly.
But yeah, can you just kind of like break down what these different things are? Most likely folks are pretty familiar with it from Pendle, but so highlighting kind of what it is, but also especially if there's any main differentiators from what you guys are doing to compare to other yield trading platforms.
Yeah. So I guess sort of first things first on it is the similarity with Pendle is you will deposit a yield token, you will deposit a liquid stake token, and you can then use that to mint yield tokens and principal tokens. So if you click there on principal tokens and yield tokens, exactly, you can see that these are the tokens we have listed at the moment. For Injective here, you can see the different maturities, and we're sort of focusing on trying to create more of a yield curve for these assets. So we have sort of 3 maturities each at the moment, and you can see here, the price of the values are kind of like the Injective yield curve. So what a principal token is, what a yield token is paying you, and this should be, for people that are familiar with Pendle, this should feel quite similar. You can click on the chart on the right hand side there of each of these things to kind of see how their sort of prices and yields and etc. have moved. And then if you scroll back up towards the top, we've created
just real quick, just so we can kind of keep it within the context that people are familiar with. So I think a lot of these assets, probably people know Injective, STDYDX from Stride, STTF from Stride. This looks like native Atom. People are probably pretty familiar with imagining that a P token is a principal token, a Y token is a yield token. So this is the equivalent of a PT and a YT. Is this the equivalent of like an SY token that you might have, or an LP token you might have in a Pendle system? Or is this the liquid staked version of the asset that's directly from Pryzm?
I think Pendle takes in a liquid staking derivative or a liquid stake token and then issues an SY token. And that's a accounting and logic thing that they need to do in order to work with their sort of smart contracts. So what we have here is like this C token here is just our name for a liquid stake token. So that might be like ST Atom. Ours is instead called C Atom, or actually, we have actually enabled people to yield trade on STDYDX or STTIA. So the C token is basically just the underlying liquid stake token. So you see here, C injective, so liquid staked injective, has an APY currently of 19.62% yield. So that kind of allows you to, that sort of gives you your benchmark where you can then be like, okay, well, C injective has that yield. That's the staking APR you were just on there.
This was kind of the question that I had. So I know, so injective staking APR is like something like, 13.7%. Over here, where was I? This is showing up as like 19, almost 20%. I'm just curious kind of like what the difference is. I know you guys run your own validators here. But what is like the delta there between the normal staking rate of 13.7 and what you guys are showing up there with 19 something?
So what you have on, if you go back on MintScan, not to get too technical on it, but like if you go back on MintScan, that 13.7% is actually that's not MintScan recording like actually how much injective yield is being paid to validators, for example. That's MintScan looking at the chain parameters, which is one of the tabs you have up there, like the far right tab on parameters next to accounts, and it's basically looking at the way Cosmos chains work is it looks at how much of the total supply is staked. It then looks at your target bonded ratio, I think it's called, and then that determines the chain inflation. So that 13-point-something% you saw there is just based around the calculations from the chain parameters. So it doesn't take into account any gas fees or kind of like other chain revenue that's distributed out to stakers. So once you factor in the other revenue that's captured, so gas fees and all the rest of it, or any revenue source that ends up being paid out to stakers, and then you convert it from APR to APY, that's the kind of yield that the yield we're displaying is the yield we're getting.
Cool. So people can, if they're using Injective, they can come and mint this LST with you guys, which I assume is then getting staked. Is that getting staked broadly to a bunch of different validators, or just directly to the Pryzm validator that you guys have?
This one's getting staked broad. These all get staked broadly. So we have a list of validators we're staking to. I think the Dojo validator is one of them for the chains you guys are on. But yeah, we spread out the stake across a mix of validators.
Okay, so
it uses it quite, not to basically, like Cosmos has quite a cool thing that's enabled by IBC. So IBC is the most people know it as kind of like a token transferring between blockchains. But IBC also enables something called interchain accounts, and what that means is someone can deposit some injective onto our chain or some atom onto our chain, and Pryzm blockchain has its own account on injective, where it can then IBC the tokens over, and Pryzm blockchain can send a message to injective saying, okay, stake my tokens, all right, claim my staking rewards, okay, compound those staking rewards. So all of these liquid staking derivatives or liquid staking tokens are controlled by the Pryzm blockchain and the governance of the Pryzm blockchain. So there's no separate admin keys and admin contracts on the injective blockchain controlling the staked injective. It's an interchain account that's completely controlled by Pryzm and Pryzm governance. So it kind of makes Stride use it as well for a lot of their LSTs, and it kind of makes for much more secure liquid staking.
So just to kind of break down what all these different tokens entitle you to, I think probably the P injective is the most obvious, right? This is just like a fixed yield. So it's the principle of like the asset minus like what the yield is, right? So like if you're buying this, you're buying there's an implied APY of like 22% compared to what it's currently trading at, which is 19%. So you're kind of betting on the difference here between this 19 and 22. It seems like the market is saying they think that this rate is going to go up over time. That's great. That's super interesting. The Y injective, right? So this is, or actually, sorry, the other way around, right? So someone who's buying this above this number here thinks that like this number will go up and they will be entitled to actually more than, like 22% APR over time. This person's just picking up this fixed rate on their injective for the next 49 days. Are they also getting airdrops? Like if, for example, people who are, if there's an airdrop to staked injective sometime down the line, are they also getting a leveraged exposure to that by picking up Y injective? Or how are you guys kind of dealing with things external just to like the normal, you know, proof of stake yield and other things that a staker is entitled to?
Yeah, so those things, I guess, similar with Pendle and other LST providers, in the Cosmos, say for example, like Stride, um, it's entirely a lot of these airdrops just used to just get dropped in your wallet, and it was great, and they'd be there, and there wasn't really anything you had to do. Now, like the way it works more with airdrops is it's kind of a BD process. Like the protocol decides who they want to airdrop. You have to go register your wallet. It's not necessarily just like immediately deposited into your account. So, or for airdrops that are deposited into the wallet that has all the contract, the address that has all of the staked atom or staked injective, for example, that will go there, and then we're having a module that will slowly auction off that airdrop into the underlying asset so that it can compound and people get the yield. For airdrops where there's kind of more process to it, where obviously Pryzm blockchain can't go and connect its Twitter, click on Tamagotchis on testnets and all the rest of it. So it's more becomes like a BD thing where protocols will decide that they want to airdrop to yield token holders or principal token holders or LP token holders, for example. So with drops, which is an LST token that's launching on Neutron's blockchain, they will be airdropping droplets to yield token holders and liquidity pool holders of their D atom, their liquid stake token. And I guess that's exactly, that's the same with when you look at Athena, for example. Athena airdropped to people doing loads of various different things, and one of those obviously was Pendle, and it was a big success as a result of that. So it's basically, in a nutshell, like a lot of these things become a BD thing, and persuading the airdropping protocol or blockchain that airdropping to yield token holders and liquidity pool token holders is a worthwhile endeavor for them.
I know one thing that a lot of folks who interact regularly with Pendle struggle with sometimes is like the amount of liquidity. You kind of touched on this, right? Like when you were talking about the broad strokes of what you're aiming to build here at Pryzm, but I am curious about this like liquidity provision piece. I know you guys just launched. Liquidity is relatively speaking low. Some of these APRs are like crazy high. I'm not actually sure what AUUU is, but even just stuff like.
Sorry, go for it. No, go for it. Sorry, that's our meme token, so that we sort of airdropped it to people so they could learn to yield trade with zero opportunity cost. So it's got some crazy yields just to make for sort of more fun yield trading for people.
Oh, okay, got it. But so for this liquidity provision piece, what is the incentive for folks to do this, right? So I'm just looking at Atom as an easy example, right? It says 0% on incentives, 18.21% on internal. I assume that's like the PT amount right there, and then the 2% is like swap fees that people are paying here. This is, I'm not sure actually like what the Atom staking rate is right now. I know you said that this is not super accurate, but let's just say it is 15%.
Yeah.
Like what is the incentive that someone has right now to, native staking 15%, and then to LP in y'all's pool, which does like kind of make up, I see there's like a lot of different maturities here, and this does feel pretty different than the way, Pendle works, where it's all kind of, each individual one is its own market. And these ones are combined into what looks like at least 3 different yield trading markets. So will you break down how the LPing works and kind of what the incentive structure looks like here, of why someone would be encouraged to go LP?
So yeah, so we are in mainnet beta at the moment. So we've done we're not actively like trying to attract liquidity at the moment. We are just kind of like been making improvements and tweaks to the web app before our launch campaign, which is starting pretty shortly. And at that point, we're going to be pretty heavily incentivizing liquidity providing. The liquidity piece of these yield derivative protocols, in our view, is super important. And so that was one of the things that like took the longest time for us to find a solution that we were happy with. The things that we weren't happy with that we had when we were building with smart contracts before is we didn't like the fact that you had to, every pool was like one maturity versus the underlying liquid staking token. And if you wanted to have another maturity, you needed a separate pool with that maturity and the liquid staking token, and then a third pool, another maturity, et cetera, et cetera. And so that for us was like, that really fragments liquidity, because you need to have a C asset in every single one of those pools. So people are needing to spread their liquidity across. It means people are having to make a decision about which liquidity pool they want to provide liquidity for, and activity may be in one liquidity pool at certain times and maybe in other ones at the other times. And so you kind of like have to make a decision about where you think that, biggest combination of, fixed yield on your PT token and swap fees is going to be. And so one of the things we really wanted to do was, and then obviously when a maturity hits on Pendle or others, for example, you need to manually withdraw your liquidity and then decide if you want to do liquidity again. Like what we wanted to do was we wanted to build an AMM formula that has the entire yield curve in one liquidity pool. And if you're a liquidity provider, you're providing liquidity for, for people that know obviously how Pendle works, you don't need a separate pool for the yield tokens. They all trade in this pool. And so you're providing liquidity to the whole yield curve. So anyone does a swap on any maturity, you earn fees. And the AMM formula we've built automatically removes expired maturities and automatically adds in new maturities. So you as a liquidity provider don't need to do anything. You get a liquidity pool token, which is a liquid token that you can trade and is earning the yields that you see there. And you don't have to worry about maturities or doing anything. You just have to probably look at the underlying assets in the pool and the yield of your liquidity pool token and decide if it's a good sort of deal for you. At the moment, this is unincentivized yield. So if you click on that Atom yield pool, for example, you'll see on the left-hand side there what is in that pool. So you'll see that it's C Atom, so the underlying liquid staking token, and then all the three different maturities, and it shows what their weights are. And so that's where you get your internal yield from, because unlike well, I guess similar to Pendle, but unlike other liquid staking, liquid staking tokens, 100% of the assets in the pool are earning a yield, or C Atom's obviously an auto compounding liquid staking token like wrap staked ETH, and then P Atom is the fixed yield tokens that are earning their fixed APY at their current prices. And then for people that are familiar with Pendle, we've got a zero price impact way of joining the liquidity pool there, where you don't need to do, where no underlying swaps to happen. So that's kind of like that piece of it in terms of the liquidity there. In terms of what we're going to do on top of that, we feel that people end up having to choose between, do I want to use my token for security, or do I want to use my token to provide liquidity? And Pryzm blockchain, to secure Pryzm blockchain, we have restaking, but it's a version of restaking where someone could take this yield pool token that's already earning 22 point whatever it is yield, or 20% yield, and you can then restake that into Pryzm's blockchain when we go live with our token. And that then means that your yield pool token is earning the underlying yield of the tokens in the pool, so the C Atoms, the P Atoms, the swap fees, and then you're also earning Pryzm inflation and Pryzm chain revenue. So it should be by far and away like the highest yield that the highest kind of like real yield that you can kind of earn on these, ignoring the inflation and focusing on the revenue, like should be far and away the highest real yield that you'll be able to earn um, on your Atom, for example. So that's why we think it's super attractive. And obviously, like even without those incentives at the moment, you're still earning, 4 or 5 percentage points higher than you would be with staked Atom, which is an extra 25% on your yield. And sort of when you start, compounding that and the difference that makes, that's enormous just by itself, even before we allow these yield tokens to be restaked.
I think it's definitely pretty interesting, this like differentiation that you guys have with how liquidity provision works. Pendle, I think there's a lot of people that have had issues moving between them. Like they're, even for example, Pendle had issues with their liquidity swap curve where there is a high amount of slippage because they had so much volatility on Athena, they had so much volatility on wrapped ETH and easy ETH and stuff like that. And there was a few cases where the pools went out of range. So, like that's definitely an issue. And I appreciate that you guys are kind of like working on this. It does strike me though that like there may be some challenges. So number one, this is kind of like a more of a fragmentation, right? Like, so, like maybe people really want to be trading, I don't know, let's just go for the middle one here, like December 24, like that's the one that people really want to be trading. And so there is some limitations on this now, how much liquidity people can get in and out of on this. And it's not, I don't know how like these weightings work, but I guess it would not be like the market deciding which one the priority should have, but some sort of kind of like internal weighting that you guys are using. And then two, with there could be impermanent loss, right? Like if people are coming in providing liquidity here, and for some reason there's some like market imbalance on like, I don't know, the 2025 one or whichever one of these here, people might have to be paying pretty close attention to these like ratios and like how all three of these assets are trading when they want to enter and exit, rather than being able to just like wait to maturity in like the Pendle setup, and then they know pretty much they're going to be able to get back one-to-one what they entered plus the additional like yield and stuff that was generated on top. So I think the benefits are clear, but I'm also curious to hear your thoughts on some of these potential challenges that LPs might be facing with this different system.
Yeah, I'd say the way to like it's we're going to publish I guess like an academic paper on our AMM formula, but the AMM formula is for those that are familiar with it, is a kind of it kind of combines some elements of balancer, some elements of the yield space formula, and the weightings of the assets are determined by their yields and their time to maturity. So it's the weightings can't ever be chosen by the team or by governance. It's all done by the kind of like time to maturity. So that's sort of removes any kind of like arbitrary nature of it. You do have that risk where you're sort of as you say, like you're not holding an asset to maturity where you're kind of guaranteed your return. But like the way that I look at it is, if you're a liquidity provider, then you hold a token, and it's a token like a liquid stake token is, or a vault token or anything else. Like it's a claim on an underlying pool of assets, and you should be aware of like what anyone who holds a token should be aware of like what the pool of assets is that they hold. So if for example you go back on that, if you look here, you've got your C atoms and your P atoms that you've got in the pool. So you're looking at that and you're like, okay, well, if I'm a yield token holder, then that's what I'm exposed to if I'm the pool holder. And if you go back onto the Earn tab and the Provide Liquidity, so the yield curve for Atom, if you go Earn, and Principal and Yield tokens, and click on Atom there, what I'd say to you is, that hopefully that's not a bug, but like that you hold each of these P atoms and you hold C atom. So I would look at that and I'd be like, okay, well, the yields on that are higher than C atom. It looks like it's a good time to hold P atoms at the moment. So I'm happy holding the yield pool token. I think that's a good trade. But if loads of people came in and they bought principal tokens, which pushes the yield down, then I might think to myself, well, I'm gonna trade my liquidity pool token for back into the underlying liquid stake token or something like that. Like it's all relative. You won't know if you're a liquidity pool token holder, then you own a basket of assets, and if you think there's better relative value on those assets somewhere else, then that's a good time to switch out. But the fun part of yield trading is it's really good relative value, and that kind of like comes onto some of our other trading tools. But like it's sort of relative value here. Like if the liquid staking token, if you scroll up, like the liquid staking token is yielding say 17%, and Atom is yielding, P Atom 24 is yielding, Set 24 is yielding 19.3%. Like that seems a good fixed yield to buy versus a liquid stake token of 17.95%. But if lots of people buy it and that pushes the price up and the discount lower, and as a result the yield lower, then that becomes an attractive time for people to be like, okay, well, I'm going to take profits on my principal token and switch back into the yield token or the liquidity pool tokens. And actually, one thing we want to do, because we want to get people thinking about these, pool tokens just like any other token. You're exposed to the price of the underlying assets and how the token does. So like we're trying to think a bit more like CoinGecko or a coin market cap, where you can kind of look at your tokens. So if you, for example, click the tokens tab at the top and then search for Atom yield, for example. So this is the liquidity pool we were looking at. So if you click on it, you can see it here, and you can actually on the price here, if you can see that compare button on the chart. So if you select that drop down and type C Atom, which is a liquid stake token, you can actually see, and then press 1 month, for example, in the time frame. You can sort of see there how correlated the liquid stake token is to the underlying sort of yield pool token. And you can see that actually the yield pool token has outperformed there by whatever it is, 3% or something over a month. So you kind of annualize that, and it's like, and it sort of becomes really powerful. And this illustrates to people like, why liquidity pool tokens should kind of just be thought of as any other token. And you can buy and sell liquidity pool tokens on Pryzm, and the AMM takes care of like minting the liquidity pool token via its kind of like balancer style formula. So that's kind of like that's a bit of a long-winded way of kind of explaining why I don't think you own a basket of assets when you own a liquidity pool token, and looking at the relative value of those assets and whether you think they're cheap or expensive will suggest to you whether it's a good idea to carry on holding that liquidity pool token or to trade out of it and swap into another token. And we another kind of thing that we built is like, if in TradFi and in things like this where you're looking at the yield of one thing versus the yield of another thing, and sometimes you might want to do a larger trade, or you might want to do a trade that reduces the price impact, or you might just want to do a trade that smooths out kind of like the price impact. You can actually just do a TWAP on Pryzm. In TradFi, that's like a time-weighted average price. I think in DeFi, a lot of people will call it, a DCA or sort of some similarity, that kind of thing. And so if you click on trade and pulse trade, for example, then if you click on trade and pulse trade, then this is like where you can do like a gradual sale. So it basically will say to you, okay, well, I want to buy P Atom when it's trading at 90% or below of the price of the of Atom, for example. So I'm buying it at over a 10% discount, or 11% discount, or whatever that ends up being. And you can basically just set a trade, say, okay, well, every block where it's below a price of 0.9, buy me one Atom until I've bought 100 or sold 100. And so I think like that allows you as a trader to set your limit prices, execute gradually so you don't have big price impact, and find the inflection point where people step in and start taking the other side of the trade, because each trade you buy a P asset pushes up the price and down, and the yield goes down. And this allows you a really good way of like gradually finding that inflection point where people are like, okay, well, this has got silly now. Like the price has been pushed up and the yield's gone down. I'm definitely going to take profits and sell some to you. So that's why we sort of built this tool, which is kind of built in. I think it's the first time like a TWAP's been built into a blockchain. And so like every single minute it can execute a trade for you, and you can see some of these ones that have actually fully executed or partially executed. You can kind of see the the actual trades happening every single minute or block or whatever, which is quite cool. But yeah, sorry, that hopefully answers some of the questions.
Yeah, no, that's great. I appreciate that. And I also do appreciate that you guys kind of like from day one have limit orders and have these kind of like, DCA orders or TWAP orders, as you would call them. I think that's great. We do have a couple questions here in the chat. So let me just go through these real quick as well. First one, I think was just an appreciation of like the thoughtfulness and decision making you guys did around being an L2 or being an L1 and all that kind of stuff. So that's great. Another one here is just a question about what do you think led Pendle to grow so rapidly and dominate the interest rate derivatives market? Do you have any thoughts on that?
Yeah, I think they did an amazing BD job, and I think the points meta on Ethereum has been incredibly successful. So I think Pendle's done an absolutely brilliant job of that. Obviously, like they launched initially, they had issues with their liquidity pools. They revised their AMM formula to be based off of the notional protocol formula, which is great for concentrating liquidity. Has certain issues, as you say, going out of range, for example, but then obviously they did, raised with Binance, did a Binance launch pool, so got a lot more exposure like that. And then I think the points meta they jumped on really well, and was like great BD and great timing by them. So that's where I think they've done really well, is kind of like adapting to the narratives and that kind of stuff. And I think I personally think points are going to be around for a long time. Points are around in Web 2. I don't see any reason for points to go away in Web 3. And so I think
maybe just following up on that, was there was another question here kind of about like, I guess saying half the reason essentially of holding one of these staked assets, being staked Atom or TIA or whatever it is to qualify for those airdrops. So there was a follow-up question here on, I know you said the current meta around airdrops is that, it's a big BD effort, but I'm not sure if you directly answered the question of if someone's holding, the yield token for ST Atom or ST TIA or whatever the case might be, would they be, eligible for, airdrops for that specific asset, or how is that being, approached in the current assets?
So I guess like from a technical perspective, let's look at let's use, like you're saying, let's use Stride's staked Atom, for example. So if you're a new protocol that wants to do an airdrop, Stride has an account, like I was explaining earlier, like an interchain account on the Cosmos Hub, where they have all of the Atom staked for their liquid staking token. They own that account. That account is controlled by the Stride blockchain. So if I'm the protocol or the blockchain that wants to do the airdrop, I've got two choices or three choices. The first choice is I can directly send tokens to that Stride account on the Cosmos Hub. If those tokens go to that Stride account on the Cosmos Hub, they can't be sent out to people because Stride doesn't have the capability to the account that Stride has on the Cosmos Hub can't send a message to say, okay, please collect all of these airdrop tokens on this new blockchain and send them over to liquid state Stride holders. So like in that situation, they wouldn't get the airdrop. So what's the situation Stride does is they will speak to the protocol that's launching and say, hey, look, this is our account on the Cosmos Hub. It holds $50 million worth of Atom. Please exclude that account from your snapshot, and please include this snapshot of all Stride Atom holders. And then what happens is the protocol will say, okay, thanks very much. Yes, we would like to drop to Stride Atom holders. So we will exclude that account on the Cosmos Hub, and we will airdrop to all the wallet addresses you've given us that are Stride Atom holders. So that's kind of how it works. Or the third choice is, which happens with other things, is they'll be like, the new protocol will be like, actually, do you know what? Like, we don't want to drop to Stride Atom holders. The second one seems to be the kind of like accepted way that these things are happening. So that's how it basically would work for Pryzm as well. Like a new protocol would decide that they wanted to airdrop to Pryzm's C atom holder or Pryzm's Y atom holders or C atom holders. They'd say, okay, well, we'll exclude all the atom that Pryzm holds on the Cosmos Hub, and we'll include all of the Y atom and LP atom holders in the snapshot. Does that kind of make sense? Like that's why it's sort of why it's kind of a BD thing basically at the moment for these airdrops.
Right. Well, makes sense. So, we've just got a couple of minutes left. Maybe we can just close things up with, telling folks what, Pryzm is up to. I know here it says it's a mainnet beta. You also talked, about not really trying to attract liquidity yet. What should people be keeping an eye out for? When are you guys going to be going to a full proper mainnet? When is our incentive starting to come out? Are you guys having an airdrop? Just anything that's kind of more of a call to action for folks if they do want to play around with and interact with Pryzm.
So we've kind of gone a sort of non-traditional route where we haven't sought any private funding or other kind of like VC money. So we're kind of like entirely self and community funded, and so we kind of have been running validators. People who've been delegating to us are going to receive Pryzm tokens, and we sort of feel very strongly that we'd rather try and give as many tokens as possible to community and not have and avoid giving tokens to kind of like a few private equity or VCs that might later sort of sell tokens in large clips and sort of wreck the community. So that's the only way kind of we've been offering out Pryzm tokens at the moment is to our validators. But what we're now going to be doing is we've been running this kind of mainnet beta, test everything out, make lots of improvements to the web app based on community feedback. And then we're going to be running a campaign very similar to the campaigns that you've seen on Pendle. So yield token like Y atom holders or Y injective holders or Y tier holders are going to get an opportunity to kind of like leverage farm Pryzm points on Pryzm tokens, and then liquidity pool holders are going to get to farm Pryzm tokens as well. So it'll look quite similar to say Athena, for example, for people that are familiar with it, with a couple of like tweaks. We're expecting to launch that in probably 3 to 4 weeks or something like that. And I think the definitely, like, obviously you and I were talking about it as well, like the dojo community are probably people that I'm definitely learning that people in the Cosmos don't really there's a lot of people in the Cosmos that aren't as familiar with Pendle and how it all works, and how kind of like yield tokens can be a super interesting way to leverage farm tokens in new protocols, and how principal tokens can offer amazing fixed yields because people are have really high demand for yield tokens, pushing down the price of principal tokens, giving these amazing fixed yields. And so I think like the dojo community probably know better than most communities what that kind of like looks like when we go to launch the protocol. So that's what we'll be doing in a matter of weeks. We're going to go to like full blown launch and like launch our campaign to launch the token, and anyone that holds any of these tokens that we've listed on our platform in yield token or liquidity pool token form is going to earn Pryzm tokens. Yield tokens is going to be, as I said, like the super leveraged way of doing it. And then I'm trying to think what else. Yeah, that's the main thing.
Sweet.
And for people that want to do it in a market neutral way, they can just deposit some USDC and borrow some Atom, and then they don't have to have exposure to the underlying Atom or tier if they don't want to. So there's some good strategies that people will be able to employ.
That's super exciting. Well, thank you, Mr. Refractor, for coming in. It's been a very interesting discussion about building a blockchain, about yield trading in general, kind of putting things into a broader perspective, and how you guys are really going about it. So I'm sure there'll be lots of folks that are interested in participating, in the next couple of weeks when you guys go fully live. Please, let us know as that's happening, and we'll start looking at different opportunities. I think, there's a lot of people that are holders of these different assets, Cosmos assets that you guys are including. I know from previous discussions that you're also looking at other non kind of Cosmos based assets, so that will also probably be pretty interesting as well. And then of course, there's a lot of folks in this community that are delta neutral, and I'm sure there'll be interesting strategies around that as well. So plenty more to come. But really appreciate you coming in here, and you're now here in the dojo, so please stick around and interact with the community and everything that's going on. So
thank you. Yeah, thanks very much. And also like love, obviously the community, the dojo community is pretty sophisticated. Like if they've got any suggestions, ideas, tokens they'd love to see listed, anything like that, we'd love to hear from the dojo community of because they obviously have experience with yield tokenization and trading. So really appreciate everyone's any and all suggestions or feedback or thoughts or whatever.
Well, thank you, and appreciate everyone who tuned in live, and all those who will be listening later. Have a great rest of your day.